So investing in stocks is a cornerstone of a sound financial plan, but for many it feels more like a game of chance. So to help us make sense it all, I'm joined by my team Chua, the financial planning expert.
Hello, Hannah. I'm here to explain the why behind the wealth. Most people just stop without planning. But here, we are going to look at how to combine investment with life goal.
Okay, good. And this is Mark, our lead analyst, who handles the numbers.
Hi, Mark. I will show you how to read the markets so you don't end up buying on hot dips that actually a cold disaster.
Studio! Walao eh! Please move out! Just one green candle only!
Meanwhile,
Hey! You haven't slept? Have you? What's going on?
Welcome, Gran.
Gran, look. I put all of my saving, even my sister wedding gift, into the durian stock. Some guy on TikTok say that they use it to make the durian taste like the gold. It's showing, right?
Yo, Hank, stop right there. You just saw a speculative stock. High risk and no knows financial history. In financial planning, you have to invest to meet specific needs. Safety to protect your capital, income for cash flow, and then grow for a long-term future. And you are just gambling.
But the dividend, they promise 50% return eh. Hey, if you sound
Too good to be true.
it is? You even check if they are listed on the FBM KLCI or the ACE market. And before you even buy a single share, you need to open the CDS account with an authorized depository agent. Okay, you can't just transfer the money into a random app, bro. You need your my card, a bank slip, and you must be 18 or above.
Ayah dia apa?
But I just click a select link eh. I think I go.
the next morning.
Alright, so now we have come to see a man who has never panicked in a market crash since 1997.
Wait a minute. Who are you?
Hey boy, what happened? You see, you listen to the public, you listen to the news, you don't listen to your bank account, is it? I listen to my bank account. See those funds, you don't pull them out, you don't water them, they will die.
But uncle, I want to be rich now.
That's your problem, not my problem. In my family, right, and all Malaysian household, you see, especially they invest in the boring stocks, also known as blue chip stocks, largely national stocks, for instance like Pedaga, Maybank. They pay dividends, not your fake dividends. These are my income. They pay for my tea, they pay for my bills, and most importantly, they pay for my kids' university fee.
So, you don't follow trends?
I don't follow trends. I follow a trend which is quite special, which is called Visit Malaysia 2026. You see, I know millions of tourists, they are coming. So, I look at cyclical stock, the airlines, the hotels, and the malls. That's local news that you can actually use. Many Malaysians also use the ETF members investment scheme to move a portion of their savings to stable fund for long-term security.
So uncle, you mean I should buy the more instead of durian?
I'm saying you should invest in what is real, not fake. Investing is about making a fortune overnight. It's about risk and return. Boring is beautiful, hey.
A few moments later.
So, I think to save Hank's portfolio, right, we need the fundamental analysis. First, we look at the PE ratio, which is a price to earning ratio, which is this one. And it tells us how much investors are willing to pay for $1 of a company's price, and company's earnings, sorry.
Exactly. For example, if the stock sells for 104 ringgit and then earns 6.5 ringgit per shares, its PE ratio is 16%. So if Hank Durian stock has a PE ratio of 500%, he's paying way too much for almost no money.
So now, for Uncle Income Stocks, we use the dividend growth model, which is this one, and we want to find the intrinsic value. Okay, so if the expected dividend is 50 cents, The required return is 8% and the growth rate is 3%. So the fair price will be 10 ringgit. So if the market is selling it for 20 ringgit, you are being overcharged.
And if you want to know how bad your loss actually is, you calculate your holding period return. You take your ending price minus what you paid and add dividends and divide by your starting prices. Yours is currently
So now let's move on to the 2026 market context session.
It's a big year for Malaysia! Analysts at CIMB and MBSB Research are predicting in the FBM KRCI index to hit a post-COVID high between 1,750 to 1,772 points. So in 2026, why? Because corporate earnings are growing and also the USD to MRL is strengthening to 4.1 level.
So the big themes for 2026 are the national semiconductor strategy and the AI semiconductor boom. So the government is investing 550 million ringgit into the semiconductor ecosystem. So this makes the tech stocks, which specifically the growth stocks, very attractive for those with a longer time horizon.
But remember, short-term investment in stock is very risky. But holding them longer also reduces the variability. However, there's no right or wrong. As a financial planner, I always say, time in the market is better than timing.
Okay, I've been doing Telegram group. I'm going to open CDS account and focus on blue chips.
Right, my good boy. And if the stock market get too scary, right, don't forget about the bonds market. They are more stable, though they still have interest rate and credit risk.
Investing in Malaysia is not just about making a fortune, it's about securing your future. So whether it's a tourism boom or Visit Malaysia 2026 or tech surge, so make sure you have a plan. So I'm Rihan and this has been Bursa Breakfast. Invest wisely.
Thank you.
Bye!
Thank you for watching our video. Right now, we'll move into a short discussion with our members. We'll be covering types of stocks in Malaysia, how the stock market really works, and most importantly, why FOMO can hurt investors more than they realize. Lots of beginners, they think investing means finding a one perfect stock and putting all in their money. But realistically, before even choosing a stock, what are the key types of stock beginner in Bursa Malaysia should understand? Rehan?
Okay, I would say that many of beginners, they are focusing too much on picking the best stock. So often they are chasing the hype, chasing the market trends. But in reality, I would say that we have to understand the stock categories in Bursa and it matters more. So for example, the blue chip stocks like Maybank and Public Bank, they are large, stable companies with a consistent earnings and also dividends. So actually they don't grow explosively, but they form a solid foundation for all the beginners. And then we have the dividend stocks such as Nestle, Dialog Group. So they are paying regular dividends maybe quarter or annually and they provide stability, especially during the volatile markets.
So instead of asking, will this stock double, beginners should be asking what role does this stock play in my portfolio, right?
Yeah, exactly. Because we do have the growth stock like Inari Amatron, Vitrox, which they fully reinvest their profit to grow faster. So they offer a higher potential returns but come with higher volatility. And also, some of the investors who are more risk tolerant, they are small cap stocks like big tech, which can grow rapidly but fluctuate a lot. So we also have REITs such as IGB, Sunway, so I generate income from property assets and help diversify the portfolio.
Okay, let's say if someone is starting out between dividend stock and growth stocks, which would you say is more suitable and why?
So for first-time investor, I would say dividend stocks because they are generally more suitable and they offer a regular income which cushion losses if prices fall sharply or temporarily. So this helps beginners stay invested and gain confidence. And growth stock, they deliver a strong gains, but timing matters a lot. Buying at the wrong time actually can hurt our profit margin and also large short-term losses, so which can be discouraging for the new investors.
So I would say the idea is start stable, learn the market, then slowly take on more risk. Now that we have talked about stock types, let's zoom out a bit. What are some common misconceptions young Malaysians have about stock market? Heng.
So many young Malaysians think that investing need higher initial costs, so they keep their money in low interest saving accounts. In reality, platforms like Momo charge low fee around 1 ringgit to 3 ringgit, with share like Maybank costing about 1,050 per lot and ETF starting below 100 ringgit. The stock market is not gambling. It means owning the real business that generate profit and pay dividends. Investing is also not about the quick gain. Strong Malaysian stock like Maybank that offer 5 to 6% dividends, much higher than the saving account. Over time, wealth will be built through the compounding, not speculations.
And personally, I think social media makes this worse right. So Mark, which brings me to this. How important is fundamental analysis compared to following market trends or tips online?
So I think the fundamental analysis is far more important. So for as a good example is the GameStop hype in 2021. The social media pushed the stock price up rapidly, but the business fundamentals are weak. Soon after, the price collapsed. So compare that to companies like Apple. Investors trust Apple because of its strong fundamental, right? So especially its ability to generate consistent free cash flow. So the trends show what's popular today, but fundamentals shows what's valuable in the long run.
Oh, I see. So hype may get attention, but fundamentals determine survival. Since we are talking about hype, let's address something many investors struggle with: FOMO. And I think Chua, you are more know about it. When a stock suddenly shoots up, how should investors control their emotions?
Right, so financial FOMO, also known as fear of missing out, happens when investor buys simply because others are making money. So a clear example, let's say Bitcoin, in both 2017 and also 2021, the prices jumped in a short time. And then many people rushed in, and shortly after, the price crashed. And some late investors are suffering huge losses. So to avoid financial FOMO, investors need to stay calm and then have a clear plan and diversify their investment, and then most importantly focus on long-term fundamental instead of hype. Sometimes missing an opportunity is better than making huge losses.
Yes, indeed. And we can say that not every rally needs to be chased, and discipline is part of investing. And today's key takeaway is simple: understand what kind of stocks you are buying. Don't let misconceptions or hype guide your decisions. And most importantly, control your emotions when investing. So once again, thank you to our members and thank you for watching.
Thank you! Thank you! Thank you! Ah!
Wow.